Lad, it's a pleasure. We've got Chris Joye online to introduce Chris Joye. Chris is the CIO and founder of Coolabah to take you through his views on fixed income investing in the current market. Over to you, Chris. Hopefully you can see us.
So you heard from a great equity income manager, almost 2%. The financial market is now saying the RBA cash rate will get to about 4%. So that is fantastic news for cash investors. The Aussie 10-year bond yield has also increased since late last year from about 1% to almost 4%. Amazingly, you can get 12-month TD rates paying over 4% today. How on earth could you invest in resi property yielding gross 3% or a little bit more, or other asset classes such as commercial property that might be paying 3.5 to 5.5. So this increase in cash rates, the increase in discount rates, it actually throws a huge challenge to all asset class returns. And we're now starting to see that manifest in the deal flow that we look at in the high-grade liquid bond market. So Jace, do you want to quickly talk through what we're seeing?
Thanks, Chris. You talk about regime change. I mean, 5-year major bank fixed rate tier 2 bonds are paying as much as 6.4%, with 5-year floating rate tier 2s paying 5.1%. And these instruments were only paying 1.3% a year ago. And that 6.4%, that compares to Aussie equity dividend yields of 6.1%, and that's including franking. So since the GFC, cash and bonds have paid terrible interest rates due to concerns about low inflation, even deflation. But in a high inflationary environment, your single best bet has always been floating rate cash, particularly if you have an inflation targeting central bank, which we have. Now in financial year 22, floating rate listed hybrids were best performing asset classes. You've just heard you can now get 4.1% risk-free in a 12-month TD. So these are exciting times. Cash is king, and bonds, well, once again, they're sexy.
Yeah, thanks, Jace. So taking a step back, late last year, we had a pretty contrarian view. If you read my stuff in the AFR, we basically came out in December last year and we said we thought the US 10-year yield, which was at 1% at the time, was going to north of 3.2. This year it's got to 3.5. Right now it's 3.1. We said the Fed would have to hike to 2.5 to 3%. At the time, markets were only pricing in a peak Fed rate of 1%. We said credit spreads would blow 100 bips wider. I don't know any credit manager that was arguing that at that juncture. And we said all of that would also force equity values in US equities down 30% or more. NASDAQ fell 34, S&P fell 24. We're also very negative on other asset classes, as you probably know. So we, in October last year, projected that Aussie house prices would need to fall 15 to 25% once the RBA started hiking in mid this year. We are now seeing the most aggressive housing correction in history. We're seeing double-digit annualized price falls in Sydney of about 19 to 20%. So as a result of that, we massively de-risked our portfolios last year. We pretty much sold everything we would normally invest in. We sold our credit, and we cut our duration to 0 years, and we boosted our average credit rating to AA. What that meant was the yield on our portfolios all but disappeared as we got rid of the credit. Whatever residual risk we had, we hedged, and that was actually, with the benefit of hindsight, the best thing to do. What this shows us here on this particular slide is the spread moves over the last 6 months in liquid investment grade subordinated bonds, bank senior paper, RMBS, hybrids, and high-grade government bonds. So we are about 80% invested in cash and interest rate hedged government bonds. And we're also short. So we hedged our risk, but we also went and put on biggest shorts in our firm's history. In fact, I don't think there would have been many investors globally that were shorting as much as we were. In total, we put $8.2 billion of credit shorts on late last year. This screen you can see here is from our systems. Every black dot is a short we've covered. On this particular chart, you're looking at $6 billion of credit shorts in US investment grade, Euro investment grade, US high yield or junk, and Euro high yield and junk. We also had some very modest Aussie credit shorts. We made money 80% of the time on these trades, and the IRR was 8.1%. So it was actually our best performing position over the last year. In addition to shorting using CDS, which is like shorting a credit index or analogous to shorting equity futures, we also put on physical credit shorts. In total, 2.2 billion. We made money 84% of the time. The IRR was 6.9%. Again, this is a screenshot from our systems. The black dots are shorts we've covered. So on 8.2 billion of shorts, we made 7 to 8%, and we were successful 80 to 85% of the time. Now, when we fast forward to May, June this year, we exited all our shorts and we started getting long again. Credit spreads had exploded. In some sectors, we got back to March 2020 levels, so incredibly attractive, and we started buying and getting long. So the charts you can see here, they're a little bit hard to make out, but the second chart is our cash enhanced fund. It's called Smarter Money, Higher Income. It's the best performing, I believe, cash enhanced fund over the last 5 years in the FE Fund Info universe. And the blue line is its yield to maturity. And late last year, the portfolio only had a 1.4% yield. Today, that yield, the chart says 4.3. Right now, it's 4.75%. And that's for AA rated liquid investment grade cash and bonds. On the right-hand side is our one long duration strategy, FIXD. It's available on Chi-X. It's an active comp bond portfolio. The yield on that in December was 1.5%. Today, it's 6%. So a huge improvement in yields. Jace, do you want to just quickly talk through some specific transactions that we've managed to buy recently?
Yeah, thanks, Chris. This slide provides a summary of recent bond deal flow, the primary market, new issues in which we participate. Now, this includes a 5-year NAB Tier 2 bond, BBB plus rated, which had a 6.4% interest rate, printed 1.25 billion on a strong book of 2.4 billion, and the credit spreads tightened 31 basis points on the fixed tranche, which provides large capital gains. Look, there was a 5-year ANZ Tier 2 bond, also investment grade, a BBB plus, with a 5.9% interest rate, and a 3-year NatWest Kangaroo senior bond, single A minus rated, had a 5% interest rate. Now, all these deals were well bid, they had very large book builds, and they all performed strongly in secondary trading, providing capital gains. Thanks, Chris.
Yeah, so basically, a year ago on these bonds, we were getting circa 1.25%, but now on very liquid, highly rated bank paper, we're not talking about hybrids, these are actually bank bonds, we can get interest rates of 6 to 7%, which is something we haven't seen for a very, very long time. This has helped performance. So in July, we had very strong returns of between 1.5% to 3.5% across individual products. Our cash enhanced funds did about 0.3%. But in, for example, our long short fund, the yield on that portfolio, which is AA minus rated, daily liquidity, it has no interest rate risk. So it's all floating rate. The current yield is 12.2%. At Coolabah, we have 33 staff, 5 PhDs, 14 analysts, 7 PMs. We run about 13 billion in AUM, and we're not trying to pick up duration risk. We're not looking for high yield bonds, and we're certainly not looking for illiquid loans. We're looking for cheap liquid bonds that are mispriced and that can generate capital gains. So we're really trying to find on an individual asset by asset basis that so-called alpha. Here you can see a chart which tracks all of our bond sales that we've affected since inception. So basically $37 billion of bond sales. We've made money 96% of the time, and we've made more capital gains than we have income from the interest rates on the bonds, which is the objective of the exercise, obviously. Looking ahead over the next year, our key cash enhanced fund, Smarter Money, Higher Income, as I mentioned, it's yielding 4.3%. We expect the target return from this portfolio will be 7.2% pre-fees in FY23 as we get a bit of spread compression from some cheap sectors. We like a few different sectors as a result of significant spread expansion. In our composite bond strategy, currently yielding 6.1%, we're expecting a 13.9% return in FY23 from spread compression, but also we do expect duration to start performing. And then finally, our long-short strategy, currently yielding 12.2%. We're looking for 20.6% pre-fees. Similar to what we did in the period after March 2020. Again, now that assets are cheap, we expect them to perform. And that's not just, the reflexive comment of a fund manager. We were the folks last year who were publicly saying we really disliked our own asset class. In terms of sectors we like, bank senior paper has moved about 100 wider. There are certain bank senior bonds that we think are quite attractive. We love bank tier 2 right now. Spreads have gone as much as 150 wider. The best levels we've seen in a long time, sort of approaching March 2020 levels. And Aussie bank tier 2 looks good globally. These are charts from our systems. Hybrids we're neutral on. I think, 5-year major bank hybrid spreads are trading at about 308 basis points over BBSW. Lockie mentioned that BBSW rates have jumped. So BBSW today is actually about 2.5%. And if you're getting a 3% margin above that, you're earning about 5.5% in running yield terms from hybrids. But across the capital stack, we prefer senior paper and we also prefer tier 2. So HBRD, which you probably know, I think it's the biggest fixed income ETF in Australia. We run HBRD beta shares and we're currently diversifying into tier 2, in addition to taking down new primary hybrid deals. But we have not been active buying in the secondary market for a while. We're super negative RMBS and ABS. Falling house prices are very bad for this asset class. You're going to get much higher loan to value ratios. Higher interest rates are terrible because you get much higher arrears. And we've seen big increases in RMBS spreads. We also think a lot of the non-bank lenders are going to find their businesses are not particularly profitable in a wider spread climate, and a lot of those cease to exist. We're also negative, very negative high yield globally. I haven't got these slides here, but I've actually just published an article on Livewire today where we've released our zombie analysis. We find up to a third of all Australian listed firms could be classified as zombies. That means they don't have sufficient EBITDA to pay the interest on their debt. Depending on how you define it, it's somewhere between 13% of Aussie listed companies and 39%. And we think we're going to see the first interest rate led default cycle in credit and in corporate Australia and globally since 1991. There was a modest increase in Aussie defaults in the GFC, but it was really a non-event. There was a decent increase in the US, but we think we're going to see a repeat of something similar to the losses and defaults we saw in 1991. And so this is going to be bad for high yield and bad for sub-investment grade, and they're key areas we want to avoid. We do like state government bonds. They're trading at March 2020 levels. So basically the best spread opportunities we've seen in history aside from March 2020 since the introduction of the global banking rules that affect this sector in 2013. On our numbers, and the banks generally agree with these numbers, we estimate the banks have to buy 220 to 440 billion of state government bonds in the next 2 years. They have to do that because of changes in the liquidity rules that Apple has implemented. But at the same time, the states are only going to be issuing about 60 to 70 billion of debt a year. So you've got, which is a significant reduction on historic supply. So last year they did 93 billion. So we're going to have a significant compression in supply coupled with the biggest bank bond buying program that anyone has ever seen. To put that in context, when the RBA bought state bonds, when it did QE, it bought 56 billion worth of bonds. The banks are going to buy somewhere between 220 and 440 billion. And we are just seeing mega buying from the banks every single day. A bank today, just before this presentation, came to me with $400 million of bids on SAFA 28s and New South Wales, South Australia 28s and New South Wales 28s. And we took some profits on some of those positions. So we like that sector as well. As I mentioned, go to Livewire if you want to read our research. I appreciate the time and the effort. Sorry, I'm stuck in Queensland and Jace is in Melbourne, but it's awesome to engage with you guys, and watch out for the zombies.
Thanks, Chris. Okay, if I could get...